Good afternoon, everybody. Welcome to our Selecting an Option Strategy webcast. I'm Connie Hill. Every Tuesday at this time, we get together and discuss what's going on in the market, what strategies might be advantageous for us to use given the circumstances. Now, I have a question for you, and I would like those of you that have a positive response to this question, put your answer in the chat. Now, how many of you like to trade around earnings? We're getting into earnings season starting this week. It's all beginning once again for the quarter. How many of you like that? And if so, is there a strategy that you think has been effective for you personally to use around earnings? We're going to talk about that in a little bit more depth here today. Now, I am joined in the chat by Cameron May. I'm glad Cameron's here, friend and fellow coach. He's here to help me maybe fill some of your questions, things that maybe I can't quite get to. Cameron will cover that. So we do want to answer your questions, so let us know. Those of you that are listening to this on the recording, because I know there are lots of you that participate that way, when you have questions, put it in the comments section of YouTube, because I go back and review those comments so that you too can get your questions answered. Now, I do hope you're following us on X. I'm Connie Hill CS. Cameron is Cameron May CS, and we'll post educational content throughout the week, things that we notice. I will do some posting about some results of a scan that I like to run first things in the morning. So those are just some of the things that you can get, just little tidbits. It's free for you to join and follow us. Let's go through our disclosures and lay out our agenda for the day. Options carry a high level of risk and are not suitable for all investors. What we talk about today should be considered informational and educational. Don't consider it a recommendation. We'll be using the Paper Money software application. That's what you download to your computer. It's the most robust version of Thinkorswim. Lots of nice tools for options traders. Investment involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. We're going to talk a little bit about probabilities today. Keep in mind they're theoretical in nature and are never guaranteed. You might want to do some practicing in your Paper Money account. Short options in the real market can be assigned at any time up to expiration, regardless of the in-the-money amount, even though an in-the-money option has a higher probability of being assigned early. That's something that's different in Paper Money than in your live account. Paper Money does not simulate early assignment, but a live account certainly can and will. All right, let you know about some workshops coming up. We're doing several of these. In fact, we've got more this year than we had last year, and last year we really ramped up a little bit. Opportunities that you might want to consider. If you can get to this spot, or maybe it's easy for you to get there, or you want a vacation there or something like that. Chicago's coming up, then Washington, D.C., then Dallas, September 20th. If you can get to those events, you'll be happy that you went, because we really give you some great educational content. It's free to you for being a Schwab client, and we are pretty dang nice to you. Like, I wish we had this when I was starting to learn the markets. Man, I would have shown up for free food and good education. So take advantage of it. All right. Typically in here, we'll talk about the market conditions, what's going on, and you guys are probably abreast of what's been going on in the marketplaces, but we'll just do a quick review. We're going to talk about some of the different option strategies. And I kind of gave you a hint here at the beginning that some of these were going to involve earnings plays since we're getting into earnings season. We're going to look at our past examples. There's a couple of follow-ups that I want to do with you before we spend our time on laying out those new trades. So going to the chat, I want to kind of get your feedback on trading around earnings. DeWomack says, usually do not trade around earnings, and that is fine. Some people are more comfortable that way. Let's see if anybody else was letting us know. Yeah, there is no free lunch except for when you come to our workshops. There is a free lunch, even a free breakfast. Okay, I appreciate you responding there, letting me know that you personally don't like to trade around earnings. But those of you that maybe are just joining right now, if there's a strategy that you have found effective to trade earnings with, go ahead and let us know. We're going to explore a couple of different ones here today. Let's first jump over to our paper money. Let's do an update on a couple of our ongoing trades. And this is, I think, an important part of what we do here is following up on some of the things that we have been following up on. How do those trades end up? How do we monitor? How do we make decisions once the trade is on? Because really your day-to-day, that's what you're doing, right? Day-to-day, you are following up on those trades and managing them. So just take a quick look at the market here. It looks like the NASDAQ and the SPX did close down on the day, kind of selling off a little bit harder towards the end of the day. But, look at this. It's still, SPX is still above its 10-period moving average, right? That shorter term moving average, but it's kind of been honoring, not really going much below it. A few times it did back here in June and then popped right back up. So actually it was today, it put in another all-time high. We're just grinding, just a little higher and a little higher. Let's look at the NASDAQ here today. It too ended up down. Not a ton. Oh no, actually that looks like it maybe was up 28 points. Okay, that changed a little bit. Hit a new other all-time high here, 23,000 plus on it as well. And you can see the 10-day, yeah, it's just following along that very closely, not trading much below that. Now let's see where our volatility index has ended up with a little bit of selling off on the SPX. We expect a little bit of a change here on the VIX. Looks like it closed here about 1735. So closed slightly higher than where it closed yesterday, but I would say we're still down here in a lower range, lower volatility area. What does that mean to you? Well, it means options premiums aren't as pricey, right? If we're not experiencing a lot of concern or fear in the marketplace, then the implied volatility piece of your option premium isn't, when volatility is low, it's not so large. Okay, that also means maybe not as juicy of premiums because that's the kind of environment that we're in. Yeah. All right, let's hop back here. Let's take a look at some of our different strategies. Okay, and then we'll go back to our Thinkorswim. So quite honestly, we have not been able to spend a lot of time on bullish strategies because the market is not really providing those opportunities. And so even though you want to have that backing, you want to know how to trade these strategies, we certainly really have had market conditions to make that too fruitful. So we haven't spent a lot of time there. We have spent a lot more time on our bullish strategies. Now, something we haven't spent a ton of time is in this last column that's labeled neutral strategies. And really what we're looking for there or saying there is maybe not a lot of stock movement. However, one of these strategies here, a straddle, technically we are actually looking for movement. We're buying a long call, a long put. We're looking for one of them to move pretty good. But it's kind of a little bit offsetting because you have the opposite trade there, right? If you're long the call and it goes up, great. You know that long put isn't going to fare well. The calendar, the butterfly, double diagonal, those are a little bit more neutral, as is the iron condor. So I just kind of wanted to point that little bit of difference out there on the straddle. Now, we are going to be playing in this playground here today as we talk about approaching earnings with some stocks. Let's take a look at, we've got a lot to monitor here in our account. Let me get rid of that. Bring up well, we don't want that. We want the monitor tab. We've got quite a few things going on here. So we're going to go through this fairly quick, okay? But I still think it's an important part of what we do. First stock here, AMD. We have a really longer dated call option here. We've got it out into November. We still have a lot of days before it expires. Let's see if we can move this out a little. Okay, about 129 days before that option expires. We did a couple of very longer dated options with the idea that at some point we would sell calls against them and turn them into diagonals. And we've had an opportunity to do that, I think, once on AMD. And let me show you what the chart looks like right now. I'll tell you, this longer dated option is doing pretty good. We got into it for $17.80 per contract. We just did one, and it is now up to $41 a contract. And what we had been doing prior to today is we were putting in a stop loss to start locking in some gains based on the option premium. That's a pretty healthy return. Now, I will say, if some of you are in the camp of saying, 130% is pretty dang nice. I don't know that I want to wait till November to trade this out. I could see that, but because we did it in our class for the purpose of showing you how to work diagonals, I want to follow through with that. Okay, so let's take a quick look at the chart here on AMD. You guys probably notice some of the semiconductors have really been taking off. AMD is no exception here. Up, what's that, over 9% today. So it popped up here. Really nice gain. It rallied up and then it started to fizzle out. Well, when we see a stock do that, this gap up is a really strong move. And if the candle ends close to kind of the higher end of where its body was during the day, then we take it as a pretty bullish sign. This candle, I'm going to just zoom in here a little bit, has a kind of a long shadow to the top side, not much on the bottom side. And so it has a little bit of a look of what we would call a shooting star formation. And that's a candle formation that can indicate fatigue. All right. There's another three candle formation that's called an evening star. And we have it's looking evening star-ish. Because of this gap up in the candle and the run up and the pullback. Usually in an evening star, this candle yesterday would be have a little bit bigger body. Okay. In any case, this message would be the same here, that we might expect a little bit of a pullback come tomorrow. Now, tomorrow, that would be our confirmation of it. It's not guaranteed to happen, right? We're just kind of reading into how did things close up here towards the end of the day. Okay. And so let's go back here to the monitor tab. At the point in the day when it had pulled back significantly, I said, let's go ahead and sell a call on it. Pretty shorter dated call with the idea of, hey, we're going to create a diagonal here. And the idea with the diagonal is selling some premium to help lower our cost basis. Okay, so we sold here today a 165 call. Where's 165? 165 is a little bit higher than this green line here. Okay, so stock's at 155, so it's $10 beyond where the current price of the stock is. It's got about 10 more days to melt and evaporate. And we're going to try to collect as much of this premium as we can. However, if the stock makes a very strong bullish move, we might go buy it back, and it might be at a loss. Okay, we'll just have to monitor it. But if the candle really is showing fatigue, we might expect it to pull back maybe the next day or two or three. It has a short time before it expires, and so that's time became melting. We should be able to see it melting if the stock just kind of stays a little bit neutral or pulls back a little bit. Okay. That is our AMD trade. Now, something that's kind of similar with AMD is GM. GM, we had done quite a ways back. We bought 100 shares in some different stocks so that we could practice our cover to call strategy. Okay, and so right now on GM, let's see, we have a call that we sold. It's got 31 more days. It's a 55 call. On it, we collected $1.46, and it's a tiny bit lower, but not a lot. Okay. And I just barely sold this. We sold it in our class last week on the 8th. We might have done it in our class or sometime that day. Okay. But basically, the stock hasn't moved a whole lot to really let us see that. Okay. So this is the day we bought the 100 shares of stock. And I kind of highlighted this date here as the date we sold the call. And as we look at this, the price of the stock, it might be a little bit higher, maybe a little bit lower, pretty close to where we got into the trade. So really, we haven't seen a ton of time decay yet. So we're just going to let it work. That's exactly what we do with these options. Is if it's a long position, you plan on holding it and you're just trying to make a little bit of money while it's going sideways, that's when we sell the call. So I'm just going to let it work and see what happens on that. Now, if you have any questions with these couple of trades, go ahead and let me know before we move on. Okay. Now, somebody, I think it was Riceberg, brought up the idea of maybe a straddle would be a good thing to do for an earnings announcement. That's one of the strategies we are gonna talk about here today. And as you probably know, Cameron May teaches the Getting Started with Options class. Actually does that Tuesdays. So this was done earlier today. I believe it was about 12 p.m. Eastern time that Cameron taught that class. He'll go through a lot of the strategies. Those of you who are trying to get familiar with those strategies, that's a great one to go to. And it looks like Cameron put in the chat a little link to a webcast that he did about trading long options over earnings and earnings announcements. So excellent. Okay, last trade we're going to look at Verizon. Now, Verizon, we did the same thing. We bought 100 shares. We wanted to practice our covered calls with the Verizon stock, okay? It had been just kind of going sideways here. We got in on this date here back on May 21st. That's the date we entered into the trade. And it kind of continued to just go sideways for a bit. We collected a little bit of premium. And then again, back here on the 8th of July, so last week, we went ahead and sold a call against it as well. Now you can see the price of the stock has dropped since then. So we should be doing okay on that call that we sold as far as trying to lock in that premium, right? That part of the trade will be working to our advantage. The question may come up for some of you as to, well, should we really still be in the stock? If we really shouldn't still be in the stock, and maybe that's a judgment call you make based on your roles and your scenario, you might say, maybe we don't belong in the stock anymore. And if that's the case, we want to go buy back that call and then go ahead and sell the long position. Now, somebody that's been holding this for a longer period of time, let's go out here, say maybe say a couple of years. And you can see it's kind of stayed quite sideways for a couple of years. Maybe it's something that somebody is holding on to because they like the dividend that Verizon pays. And so it's a longer term holding, and they're selling that call to just generate a little income while it doesn't do a whole lot in addition to the dividend that it pays. Okay, that kind of person might say, well, there's some longer term support here about 40 and change. And maybe as long as it stays over that and above that, maybe they'd feel comfortable staying in the trade. Okay, so it really depends on the scenario. If somebody was doing it maybe a little bit shorter term, we could say, well, both the moving averages are down, the 50, or rather the 30 and the 10, as well as maybe if you're recently putting in a lower low. Okay, so if it was for short-term purposes, somebody might decide to get out by their call and sell the stock. Now, it does have earnings coming up. And one thing when you've got a long position of stock, if you want to let your winner run, what do you have to do? You've got to keep it over earnings, right? You don't go in and out and in and out. That's kind of a shorter term mentality versus a longer term mentality is, you hold over earnings. So just wanted you to be aware that it's coming up, but it may not make any decision for this. So what we're going to do is we're going to put a stop loss. If it breaks down below, say, this 40.86 range, let's maybe give it 2%. So let's calculate this 40.86 times, let's go 0.98, would put it at about $40.04. Now, because we have sold a call against the stock, sometimes if you don't have naked call writing privileges in your broker account, you're going to find that they are not going to allow you to put a stop loss on at the same time that you have a covered call, because that creates two obligations on the stock. So what we're going to do in this case is we're going to set an alert at that price. Okay, $40.04 is going to be kind of down here. So some of you might feel like that's even too much, but I'm going to go ahead. We're going to create an alert here. We're going to say, all right, if the stock gets at or below $40 and what was that, 4 cents? Let's type it all in, 40.04. Then we'll let it send us alert. We'll evaluate it, see if it's time to just buy back that call and exit the stock. And if Verizon has bad news, that might happen sooner rather than later. Okay. But again, it depends on what your initial approach was, why you're in the trade in the first place. Okay. All right, those are the trades we're going to follow up on right now. Actually, I'll give you one more little update that we did today. CRISPR, CRSP. This is one that made a technical violation, meaning it's breaking down. It's not continuing up, and it's really a pretty volatile little stock, okay? And so even though we got in here last week with the idea that it was continuing, breaking out of this short-term flag formation, what has it done? Plop, 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 plop. And it's almost made a full retracement down to the bottom of this flagpole. So that is letting us know, okay, maybe it's pulling back, maybe a new trend change is in place, but that was not the reason that we wanted to be in the stock at that point, right? We wanted to, if it was continuing to maybe go up on its flag pattern, we wanted to capture that. So we went ahead, we exited the trade at a loss because it was time for us to be out, plain and simple. All right, let's go on. Let's talk about maybe some of those stocks that are coming into earnings, and let's talk about maybe a couple of opportunities. Now, I'm going to preface this by saying that you might be a person that even after our discussion today, you still decide you don't want to trade over earnings, and that is just fine. This is to just kind of explore maybe some ways that a trader could treat it, okay? Could treat earnings. Okay, first stock we're going to take a look at is Pepsi. Now, on the chart, I've got a ThinkScript. Some of you might be familiar with this. It's called the Market Maker Move. What's the Market Maker Move? Well, as we come over here to the Trade tab on Pepsi, we see this little icon here. It's an MMM. 2 M's on the top, 1 N on the bottom. It stands for Market Maker Move. And it's basically how much is priced into the options for a particular event. This event happens to be earnings, but it doesn't, it could be an event like an FDA announcement. It could be an announcement like, say, whether a lawsuit is going to be settled or not. Okay, so it can just be big news, and they're saying, okay, this is what we're pricing in the move as for this event. So the move is being priced in at either plus or minus $5.63. That's the expected move over earnings. And so what's nice, somebody created a nice little script, I'll share it with you, that puts in the Market Maker Move, gives you the dollar value there, and gives you the percent right there. How handy is that? That's pretty handy. Let me go ahead and I'm going to copy this out into the chat for those of you that are here live. Those of you that are not here live, I should put my initials there. You might want to do a pause here at the recording and come down to this label. I'm going to read it to you, okay, for convenience sake. It's cap sensitive, and there are all lowercase letters in this one. It's W8K0 6T and L. This up and down, you're like, ooh, is it a 1 or is it an L? It is an L, okay? So if you wanted to add that, you'd take that URL, go to your setup, say open shared item, plop in the URL. You don't want that description that I had after the URL, right? You want to get rid of that. And then just hit preview and import. And this is how I have it. It's saved 3-month, 30 SMA and MMM for the Market Maker Move. Okay, that's what I called it. Call it whatever is appropriate for you to call it. All right. On Pepsi, based on the earnings, now they're not reporting until Thursday, and it's going to be Thursday before the market opens. I wanted to do something maybe a little further out this week than something tonight or tomorrow. So Pepsi is expected to move between 130 and stay between this range, 139.44 and 128.18. This is the expected market maker move. And sometimes you'll see it shift a little bit during the day, depending on what's going on with the price. Earlier today, it was a little bit lower than 130. Well, it was actually a little higher because I was kind of rounding up to 140. So a little bit higher. And here it was staying pretty close to around 128 right now. So that's the price, the implied volatility that's priced into the options. And kind of the long way to go about it is you'll look at the straddle price for the at the money option. Okay. Current price of the stock is 133.81. And so these options that expire on Friday, look at the implied volatility that's priced in there. Right now, about 60+% compared to you go back in time where earnings would be over, implied volatility will have already come crushing out of the options, and that value is significantly lower. It's almost twice as much right now on these options that expire on Friday. So that lets us know, they're a little bit juicy, right, in that scenario. Now, let's, we don't need 100 on here. On one of our trades, we are going to need 100 strike prices, but we're going to pull up 30 strike prices here. And what we're going to do is we're going to sell an iron condor. All right. An iron condor is where we sell a short put vertical and we sell a long put vertical. And what we're going to do, I'm hoping these numbers still work. I mapped it out earlier today. Ideally, what we're going to do is sell something that is beyond the market maker move. Okay, so it's beyond 139.44 and beyond 128.4 or 128.18. That might end up being 128, but it has a little wiggle room. It might end up being 140. Let's see. Yeah, I had something else planned here. Let's see if these numbers still look good. Okay, we're going to use those options that expire Friday. Because once the announcement comes out Thursday morning, what happens? Implied volatility just comes crushing out of these short dated options. It just comes flying out. It's kind of like somebody opens the balloon and the air just kind of fizzles out of it, right? And then the idea here is that maybe we've sold some premium that we can still hang on to and collect on. All right. Initially, what I was looking at doing here on the put side of things is looking at the 128, 126. We might change that a little bit. We'll see how this prices out here. 128 would be where? 128 would be just barely below that lower range, right? And we would want the stock to stay above that. If somebody wanted to go out a little further and bring in less premium, that certainly is an option. But let's go with what I had initially decided, 128, 126. And what we're going to do is we're going to say sell, and I'm going to choose an iron condor, and it's just going to go and grab the next strike prices in sequence. And we're going to put the strikes where we really want them. We're going to spread this out by $2. So we're going to change the 127 to a 126 here on the put side of things. All right. Note that that's a 20 delta. We may come back and change it to be a 16 delta. Okay. But at least we wanted it to be below that market maker move to some degree. Now, on the call side of things, what I had mapped out that we might do here would be 141, 143. 141 has a 17 delta. And I'm kind of feeling a little bit more warm and fuzzy about that 17 delta than the 20 delta, because where does that put us? 141, the market maker move ends at 139 and some change, so that actually gives us a little bit more leeway. Let's change our strike prices here on the call side. So let's, what did I tell you we're going to do? 141, 143. So we're going to change that. 141, 143, and right right now that's bringing us in about a 52-cent credit. We may have to leave it there, okay? And so what would be wanting what we want the stock to do is stay between 141 and 128. So sometimes what I'll do is I'll come in here and put some marks on my chart at where those strike prices actually are. I didn't grab it. Let's grab it this way. So let's go 140. I think it was 141, right? 141. Okay, that's as close as that is. And this one was pretty close to the 128. So not a ton of leeway below that market maker move. Okay, that's pretty close. 128 and a penny, good enough for what we're looking at here. Now, in an ideal world, sometimes we don't get an ideal world, right? But in an ideal world, if the stock didn't move beyond those boundaries, we might get to keep both of those premiums. One for the short put vertical, one for the call put vertical for that combined 50 cents, 52 cents, okay? That's our ideal world. Is it possible that maybe the stock has a big move up? Okay, that's one of the outcomes we could have. If the stock makes a big move in a bullish direction, we might start feeling some pressure on our bear call spread, our short call vertical, right? We might start feeling that pressure. And what we might start seeing here on the short put vertical side is that we're getting closer to maybe being able to buy it back for peanuts. Peanuts maybe as a butt or a penny or 2 pennies, 3 pennies, okay? Where we might say, let's lock in the profit on that side, manage our winning side, lock in the profit there, and then see, maybe it comes up and it's up in this range where the market maker move is. And so it might show that we're down on the position, but as time continues to decay throughout the day on Thursday, and if we're still in the trade on Friday, it will continue to decay. And we still could end up having a profitable trade on both sides. Now, the opposite could happen. Kind of interesting with Pepsi, it's been pretty sideways for a long period of time. It was just recently that it kind of made a move up, looking maybe like a little bit more bullish, right? Our moving averages are just sloping up here a little bit just with the recent price action. So in the event that maybe things do drop down here, then it's going to be the puts or the call spread that probably is going to look nicer to us. And it's going to have the put spread under a little bit of pressure if it really does drop that low. Now, is it guaranteed? I want you to answer this to yourself. Is it guaranteed for the stock to have to move to these boundaries, to the market maker move? Is that like a guarantee of any sort? Hope you're saying no, it's not a guarantee. It's just what's been priced into the options. And so that's why we're saying the expected move, plus or minus, we don't know what direction, those are the boundaries. Now, some of you might take a look at this and go, I don't know if it's worth the risk. Is it worth risking $2 minus 52 cents, or basically $1.48, and that could be on either spread, $1.48 to have a gain of 52? Basically $52 per contract, right? We've got a lot of open interest there. There's tons of contracts. Position sizing wise, in our account, we'll allow ourselves to risk up to $1,500 per trade. So we could do several contracts here if we wanted to. Is it theoretically possible for us to lose on both sides? Let's think of that. Is it theoretically possible for us to lose on both sides? It kind of, you might think of it in the sense of saying, well, if the call side, if the stock pops up, yeah, the put spread's working. If the stock drops down, possibly it's the call spread that's working. But what if you panicked and you went back and bought back the call spread at exactly the wrong time? Could you lose on it? Yeah, if you bought it back at completely the wrong time and the spreads were really wide and you got panicked and you went and you bought it back, and then you did the same thing on the put side and you bought it back at the most possible worst time, yeah, you could lose more than the theoretical $1.48, right? Because if you got in a situation where there were really wide spreads and the market hadn't recovered and those spreads hadn't come back together again, okay, yeah, theoretically you could lose more, but in an ideal world, one side of the spread is going to work and not the other. But I have seen extreme movements. I've seen extreme movements where the one side went beyond the market maker move, like right after the announcement, and then maybe by the end of the day, it was down below the other market maker move, just because the stock was so volatile, whatever the news was. Okay. So yeah, that is a possibility, and we want to acknowledge that. Okay. We're going to do this. Why are we going to do this? Because we do practice trades, right? This is where we want to practice in our paper money account. So we're going to go ahead and practice trade this. If we can lose possibly a $1.48 per theoretical max loss, assuming one side works and the other side doesn't, we could do in the neighborhood of, if we say $1,500 divided by 148. Oh, I did that wrong. I needed to clear the memory out here. Okay, $1,500 divided by 148 should tell us how many contracts we could do 10. If somebody said, you know, it's speculative, it's over earnings, we really don't know, they might say maybe that type of a trade, maybe they only want to risk $1,000 per trade versus $1,500. They may even say $750. Maybe they might just go with half of what their regular risk tolerance is just because it is speculative. Okay. Let's suppose that's the case, and let's just only do 5 contracts. Okay, so we're going to put this here at 5. We're not going to put in an exit order because more likely than not, we're going to manage them separately. We're going to manage it by the call spread. What's going on there? We're going to manage the put spread separately. And many times traders find that they get out of the trade at different, like the call spread at one time and the put spread at another. Or if this stock lays an egg, we'd love for it to lay an egg and just go flat here in the middle, right? Then we might say, right, let's hold it one more day. Let's collect the whole premium, or that might be the intent. Okay, so that's why we're not going to put on an exit order, but we're going to send this off into our option strategies bucket. Again, speculation trade. Some of you might go, no way am I even thinking about that. Okay, I want to hit another potential opportunity for us here. Let's go with this one, Triple M. You've heard of Triple M, 3M company out of Minnesota. I think it's St. Paul, Minnesota. It also announces earnings, but it's on Friday before the market opens. Okay, so if we were to go with the shortest dated contracts, we'd get into them today and they expire Friday, just like the ones we did here on Pepsi. In this case, this stock doesn't seem to be so range bound right now. It's been making some higher highs and higher lows, so maybe a little bit more bullish. We don't know. Somebody said, you know, could we explore the idea of doing a straddle? And that's actually what I had in mind for this. The expected move is up to what? 164.61 and down to 149.36. That's the market maker expected range, about 5-12%, or in the neighborhood of about $8. On this trade, we're just going to go at the money. Closed at 156 and some change here. So let's see. Actually, it looks like the 157.50 is our at the money option. When I was looking at it earlier, it was 155, but it's kind of changed in price a little bit here. So what are we going to do? We're going to buy one put option and one call option of the same strike, 157.50. Here we go on the call side. That's going to be about an $8.68 debit. Now with the straddle, we're buying the long call and the long put, so we need it to actually move big. we want it to move at least the amount of our debit here. Well, what's the expected move? The expected move is actually less than that. Look at that expected move. Usually it's based on the at the money option, but it's not precise and to the penny, okay? But it's just kind of as a general. And so for us to even break even, we need it to go beyond $8.68, and we would need it to happen on Friday after they announce and before the market closes. Is that likely to happen? One thing you can do, in the interest of time, we don't have time to do this. You might want to go back and see how big the moves have been over earnings in the past. We're just seeing this one earnings here, where before they announced earnings, it closed down, and then by the end of the next day, it closed up quite a bit. That was a range of, let's see, 126.09 to closing 136.33. So that was about a $10 move that it made last time, okay, just in that one day. Now, these types of trades, you don't have to do them, and this is true in the Iron Condor as well. You don't have to do them for the week when it expires, okay? We're just talking about being speculative with some short-term trades that do expire, okay, on Friday. Now, you might look at this and go, I'm not so interested. And I get it. You might not be interested. What we would ideally do in this scenario, they would announce earnings, and we would want to pull up the pre-market, what's going on. So change your chart here to a 1 day, 1 minute. And then make sure in your settings, where'd it go? Here's our chart settings. Come over here to equities and show this extended hours trading session. Make sure you put the check mark there. And then I like to see it grayed out, that highlighted in extended hours trading, so that you can see after the market is closed what activity has been going on. And so just kind of seeing what happened today, we can see not a whole lot has happened since the market closed on this one, okay? But the news isn't coming out now. It's going to come out Friday morning. So we would be able to see the market's initial reaction to it based on looking out here in the pre-market. Okay, does that make sense to everybody, how you do that? If you don't have those selected in your options, in your settings in the graph, then you'll be like, where did the price go? I don't see it moving. Okay, make sure you go out there, get that checked so that in 1 day, 1 minute, so you can see what's going on right then, and that'll give you an idea. If it gaps up, we might think, oh, okay, maybe the call side of this is gonna be the winning side of the trade. And you might quickly go and sell your put for whatever you can get out of it, right? Because at the end of the day, zero extrinsic value is going to be in either of those options, right? It's just time value that's going to be sitting there. So if it looks like, yeah, the good news seemed to be positive and the market seems to be positive, that might be what a trader might end up doing, is say, well, let me see if I can get a few cents out of this put. Maybe you can, maybe you can't. And then you have to watch it like a hawk, and then you try to make some effort to get out on the winning side of that call. But it really is going to have to make a big move. We kind of consider the break-even point there based on what our net debit is, in this case, $8.68. Okay, we're just going to do one contract on this, very speculative, and we're going to send it to our option strategies grouping. And guess what? I'm going to be tracking that Friday morning. I'm going to have to be all over that particular trade. All right. Again, you might be somebody that wants to explore some different strategies over earnings. You might be a person that's like, that's not for me. Let me let the earnings come out, and then I will trade based on how the market's reacted and whatever the news is. All right. Now, I do hope you're following us out on our Trader Talks channel. It makes it so much easier to find our content. You can see what's coming up next, which will be tomorrow morning, Trader Talk in Today's Market with Kevin Horner and Brent Moores. I'll start the day off right at the opening bell. And then underneath, because I'm on the home right here, we have some new categories that we're doing some videos on. And one of them is called Bite-Sized Content. And I'm doing a little series for those of you that are trying to get some things done on Thinkorswim. just short little videos showing you how to do certain things. So my most recent one here, we got it up yesterday, is how to create custom columns on your trade tab in Thinkorswim. Okay, so take advantage of that. Now, I did not see a survey out there today. If so, Cameron will post it again because he's really good about doing that, but I did not see one. If I totally missed it, then please fill it out for me, okay? Cameron, thanks for helping us out in the chat. Thanks to every one of you for being here today. And, you know, as far as different option strategies, it's good to experiment in paper money before you really do stuff in your live account. Get a feel for the strategy, get a feel for if it goes right, feel for if it goes wrong. Okay, I'm just going to say practice, practice, practice. All right. Have a great evening, everyone. We'll see you bright and early, right at the opening bell tomorrow morning. Thank you. Have a good evening. Bye-bye.